Hey, everybody, it is good to be with you today. Today, I want to talk about calendar spreads in plain English. So that's kind of the goal here today. I'm joined by James in the chat. Appreciate James. Make sure you check out his various webcasts, including uh, his Investing Master Series, which occurs on Tuesdays. So you can follow James or myself on X at Brent Moore CS, at James Boyd CS. And hey, appreciate each of you joining live, taking some time out of your day. And if you're watching on a recording, that's great too. Before we get too far into this, though, let me just mention a few important things. And one is that options do carry a high level of risk and are not suitable for all investors. Furthermore, the material today is intended for general informational and educational purposes only. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And the paper money software application is provided for educational purposes only. Paper money does not assign short options early, so that's different than your live account. And that's something relevant to today because we're going to be dealing with short options today. Rolling strategies can entail additional transaction costs. All investing involves risks, including loss of principal. And let's see. There's no guarantee that execution of a stop order will be at or near the stop price. Past performance is no guarantee of future results. Schwab does not recommend the use of technical analysis as the sole means of investment research. All right, let's head on over to the Thinkorswim desktop software. That's what we're going to be using today to explore calendar spreads. But this is the market as we sit. And, it's had quite a run up. I was wondering, this was kind of a resistance level we were potentially looking at, but boom, the news trumps everything. And right now there's been some positive news and hence we're up another 1.25% today. I don't know when that's going to turn around, but right now the markets are doing pretty well. This old resistance, by the way, certainly can act as support in the future. So if this comes back down, we may look for this to potentially be some support. I don't know. We'll have to see. But what I want to do here is I want to go through talk about calendar spreads, and let's just kind of talk about them as we distinguish between calendar spreads and vertical spreads. And so let me just, I'm just going to write it out here real quick. It's not going to take too long, but let me get an appropriate color here. So in terms of verticals, I'm just going to abbreviate vertical spreads and calendar spreads. There are two different types of spreads. And in terms of, say, vertical spreads, they're more directional, okay? If you're bullish, you may do a certain type of vertical spread. Whereas or bearish, you may do a different type of vertical spread, but with the calendar, generally it's a little bit more neutral. Okay, we could say non-directional or more neutral. Now we can skew it a little bit more bullish or bearish if we want, but for the most part, if you're looking at direction, we're looking more at vertical spreads and rather than calendar spreads. What's the difference between the two? Vertical spreads, you're using the same month different strikes. Calendar spreads, you're using different expiration dates, same strike. Okay, that's the difference. So here we're going to have under vertical spreads, they're going to be the same expiration. And with calendar spreads, they're going to be a different expiration. And then finally, and we're just talking real high level here. The other thing I want to mention is with the vertical spread, the volatility impact, okay, is generally pretty low with them. The two contracts largely cancel each other out. So volatility impact, we'll say lower. And for for calendar spreads, the volatility impact is going to be a pretty key consideration. We'll get into this more as we look at this, but it's going to be a key consideration. Look at that implied volatility. So just to reiterate, vertical spreads, same expiration date, different strikes. Calendar spreads, different expiration dates, same strikes. All right? So let me just go. I'm going to clear that off. We're going to move this out of the way and do that. Let's go back here. So if we're doing a calendar spread, we're going to be looking for a more of a neutral type trade. Okay, a little bit more of a neutral type trade. And one thing we may want to do is we may want to look, because it's more of a neutral, so a stock, maybe it's going a little bit more sideways. Now we have something huge coming up, and that is we've got earnings right now. Earnings season has begun, and we're going to have a lot of companies come out with earnings. And if we're looking for more neutral stocks, I'm going to try to avoid earnings, but there are some benefits with companies that come out with earnings. Let me just kind of just illustrate here. Looking at Microsoft. If we look at Microsoft, we've got earnings coming up. And if I look at implied volatilities, what you'll notice is with Microsoft, and this is most stocks, when earnings is approaching, you tend to get an increase in implied volatility. You see that? This is an earnings coming up. Here's an earnings coming up. You tend to get an increase in implied volatilities. All right? So there we go. That we could look at 10 different stocks, and in general, that's going to be the pattern you see over and over is as earnings come out, as earnings are approaching, implied volatilities go up. Now, it's not always perfect. If there's a huge market event well ahead of earnings, maybe implied volatilities are going to be extremely high before then and they actually go down. But that's going to be the exception, not the rule. So there we go. So that's what we're going to consider. I want to consider earnings here, because if we pick out an expiration date, and we're going to be talking about the front month expiration date, that's still out a little ways. I'm going to say about a month before expiration, we're likely to get implied volatilities that are lower that are going to go up. Okay? So that's going to be one of the things we're going to be looking at. Let's look at, say, NVIDIA. Okay, here's NVIDIA. Notice you're going to see kind of a similar pattern. Implied volatilities go up before earnings. So if we look out for something that has earnings in about a month, that may be where we're going to start for that. But furthermore, I want a company that is, maybe I anticipate it's going to be a little bit more neutral, because remember, this is more of a neutral trade. If you have any questions, feel free to type those in the chat, okay? Between James and myself, we'll try and get your questions. How do I find what's coming out with earnings? Well, there's probably different ways, but I'm going to go to the earnings calendar. I'm going to go to Market Watch, and I just have the S&P 100 listed here. But I can look here, and I just have it listed under List View. And what I can see is this. I can see, let's see, today is the April 17th. So I'm kind of going to be looking kind of in this range here. And we can look at some different companies. And I mentioned NVIDIA. Here's NVIDIA. And we said, well, I don't know if that's going to be so neutral. But you can see some other companies. Home Depot, okay, Cisco, okay, Target, Walmart, CRM, and so on. So let's look at these and look for some that maybe are a little bit more on the neutral end of things. And we'll do this, okay? Now, question in the chat. What strike price are we going to pick? I'm going to get to that, but in general, I said this is going to be of a more of a neutral strike, neutral forecast, and we're going to want the stock to go where our strike is. So if it's truly neutral, we're probably going to go pretty much at the money in terms of strikes. If we're a little bit bullish, maybe our strike will be a little bit higher. If we're a little bit bearish, then maybe a little bit more a lower strike. Okay, but we'll look at this in just a little bit. But let's just kind of look at these a little bit. Now I mentioned here's NVIDIA, and if you feel NVIDIA is more neutral, then maybe you would consider this. If you truly think NVIDIA is going to kind of, obviously it's not going to be flatline, but if it is going to kind of hover around the 200 level, then we'd probably pick a 200 strike. Now, let's look at some others. I mentioned some that have earnings in about roughly a month here. We said Costco. Well, here's Costco. Well, that's a little, in my mind, this looks more sideways. Now, that doesn't guarantee it's going to continue to go sideways, but very often, traders who are looking for more neutral trades look for stocks that are going a little bit more sideways. Okay. Now, that trend can certainly change, no doubt on that. Here's another one, Walmart. Walmart, a little bit more sideways. Maybe we would consider something like that. Here's another one I was looking at. Palo Alto Networks, maybe a little bit more sideways, maybe a little bit more bullish on this, I'm not sure. But these are all companies that have earnings set to go out in roughly a month. There's one more, CRM. I'm going to call this more of a neutral trade. And what you can see here as we look at CRM, at the risk of repetition, here was our earnings. This is what implied volatilities did. Here was our earnings. This is what implied volatilities did. Yeah. So our goal is going to be to sell a contract. Remember that we're going to sell a contract and we're going to buy a contract. We're going to do a front month, which we're going to sell. So I'm going to just call this front. And I say month, but of course I just mean the front, the earlier expiration date when I say that. We're going to sell out about roughly 30 days, about a month in time. Okay. And we're going to buy roughly, and this is just, you can do it all sorts of ways, but I'm going to give you the logic for this as kind of an introductory approach to calendar spreads. Why would I sell out about a month ahead of time, about 30 days ahead of time? The rationale is this. This trade benefits from time decay. The front month, theta, which is a measure of time decay, a measure of how much money, everything else being equal, the trade benefits on a day-to-day basis. That's theta, Greek letter, theta. Every day that ticks off benefits you on that front month. Time decay helps you out. Okay? On the back month, it actually hurts you. Theta works against you. So we have one working for us. We have one working against us. Which is going to win? Well, in general, what we want to do is we want to maximize the rate of time decay on the front month. And we want to minimize the rate of time decay on the back month. How do we do that? Well, if you guys have looked at time decay in the past, or you've watched our webcasts in the past, very often we say time decay really starts to ramp up with about a month to go until expiration. Okay? That means we're going to be, if we hold this for, we'll say the better part of a month, not the full month, we're not going to hold it all the way to expiration. But if we hold it for most of that time, we're going to experience the rate of time decay being higher during that period. Whereas this time period, the one we're buying, we're going to be holding it from maybe the 60-day mark to the 35-day mark. Our rate of time decay is going to be lower. Now, is there anything magic about the 30-day mark? No, not exactly. These are just kind of rough guidelines. So if you look at some sample investing plans, for example, it may say sell 20 to 40 days. In other words, you're probably not going to hit 30 right on the nose anyway, but that's kind of the ballpark we're getting at. We're going to buy, the one we buy is going to be out a longer period of time. And remember, we're doing the same strike of both. This is going to benefit you in terms of theta. Okay. If you have any questions, let me know on that. All right. But what I'm going to do here is I'm going to say, hey, look, this is kind of the area. Let me just clear off my palette here, so to speak. Here's kind of the area. Sorry, that's a little bit of a crooked line of what I'm anticipating this stock staying in, being about 200 and 180. So I'm going to go at about 190 for our strike. That's my target. If I'm very directional, I'm very bullish on this, we're probably not going to look at a calendar spread. If I'm very bearish on this, I'm probably not going to look at a calendar spread. In this case, the 190 strike would be we're a little bit bullish on this. That's no problem. That's still kind of in the ballpark of what we're looking for here. So let me just see if there's anything else. Now, let's look at our strike prices. Let me just go, I'm going to go to the Analyze tab. I'm going to go to CRM. I'm going to go to Add Simulated Trades. I'm going to go out about a month. Okay. I'm going to go out I'll go to May 15th. Okay. That's a monthly contract, probably a little better open interest, a little better liquidity on that versus some of those weeklies. Plus, it's about a month. So I'm going to go here, and we said 190. Now, should we do a call calendar or a put calendar? In general, we're going to keep them out of the money here. If we're not going right at the exact strike price of where we're at, I'm going to go out of the money. Well, the 190 is going to be out of the money here for us on the call side. That would be in the money on the put side. In other words, on the calls, if the strike price is going to be above the current price, that is what we're calling that out of the money. And that means it's much less likely to be assigned early. So that's the contract we're going to be looking at. And I'm going to look to sell this contract. So let me come over here. I'm just going to click on that bid price. And we'll look at this in just a minute here. This is 28 days to go to expiration. If I go out, we'll go about 2 months, 62 days to expiration. One thing you're going to notice is this is a much more expensive contract. Let me just click on the ask price here. Same strike, different expirations. This one is more expensive. That's how it is. Calendar spreads are debit spreads. Your max risk on the trade is going to be the net debit of the trade, which is going to be the difference between our prices there. So roughly 520. It's not always going to be exactly like double, but that's how it is. The further out you go, if instead we're doing 60 days, if we did 126 days and we looked at it, notice that's a $15.50 contract instead of a $10 contract. That would be a more expensive trade. Now, there's probably pros and cons there of doing either one. If it's a more expensive trade, we're risking more. And so that's kind of the big thing. We're risking more. But also, it probably gives us the opportunity, if we do want to roll it out in the future, to roll it out more if there's a bigger difference. But this is going to be the standard blueprint that we're going to use in this class. If you look around and see different people do calendar spreads, they may not always do it exactly this way. But I think this is a good kind of introductory way to do calendar spreads here. Now, let's take a look and see what this looks like. Remember, the net cost on this is going to be the difference between those, about 520. If I look at that risk profile on this trade, and I were to come down here, and if I were to just kind of scroll this over, you'd see this bottoms out. This would be a very bad trade if it went all the way down to $140 at this point, but it bottoms out about 520. Same thing on the high side. If I went over here, it would bottom out about 520. That's the max risk on this. That's the prime consideration I want you to think about right here. You can look at a max return, and in this case, the max return is about the same as the max risk. And there's pros and cons here on this. One of the pros is, hey, look, this whole range about kind of where we're looking is in the more probable range than something that's way, way high than the 250 level or the 140 level or something like that. That's good. But the problem is, this is kind of an itty bitty target. You see this kind of tent shape that we have here? This kind of tent shape is what calendar spreads look like. The peak of the tent represents our strike price. Do you see why when we say we have a target price, if stock's going to go somewhere, that's where the strike is? The 190 strike coincides with this 190 point right here. Okay? Now, I don't want to lose anybody. If you have any questions, type those questions in. So that's where that is. Now, one thing you'll notice is there's a purple line here as well. The blue line, which I kind of covered up a little bit with the my yellow markings, the blue line represents expiration date on this. The purple line represents today on this. In other words, if we do the trade right now, stock's right about here right now. If we do the trade right now, it's we're not in a huge winning position. Of course not. That's just not how it works. That would be nice, but that's not how it works. Over time, we'd expect this purple line to move closer to what the blue line is. That's what we call the effects of time decay on this trade. Okay? And that's on the whole trade. On the whole trade. Time decay is helping us out. Why is time decay helping us out? Well, one reason is because the front month time, the rate of decay on the front month is higher than the rate of decay on the back month. We already mentioned that. Now, that's not always the case how it's going to help you out. If stock goes way up, time decay can actually work against us. Okay? Time decay can work against us if it goes that way. But in this, where we're starting out the trade, time decay is helping us out there. Okay. Now, let me go and clear off that drawing here, and let me just kind of go to the next thing. What about probability here? Okay, and let's talk about probability. Today is the 17th. Our expiration date of our front month is May 15th. So I'm going to put May 16th up here in the upper right portion of the page to fully incorporate that day there. Okay. And we're going to set my slices to break even. Here's my break even. So about a 40% probability on this trade as it now stands. That's pretty typical, I must say, on calendar spreads. They're not really typically high probability trades if you just do a straight up calendar. Okay? Just being honest with you, that's how it is. This is a neutral trade. We want the stock to go neutral, but from just the probability standpoint, there's a decent chance this could go one way or the other. Now, there's some things that I'll talk about towards the end to try and help increase our probabilities on this, but this is pretty standard, okay? Now, let me hit some questions up, and then I want to talk about implied volatilities here on this. Implied volatilities. So, questions. Since you can lose on stock going too far up or too down, would you ever use one cancels the other order there? Okay. So you can lose on either side. And we're going to talk about management of this trade. Tim said, when do we exit and do we get out of both legs when we exit? I'm going to talk about exiting here. If the trade, this is a neutral trade. So I'm going to hit kind of all three questions here at once. Okay. Cecil says, Is this a neutral strategy or neutral to bearish strategy? This is generally we're going to call it a neutral strategy. Remember, whatever strikes you pick is where you want the stock to go. So if the current stock is at 180 and we pick 190 strikes, we'd say it's kind of neutral to more bullish strategy. If the stock were at 200 currently, then we'd say it's more of a neutral to bearish strategy. If stock's right about 190, we just call it a neutral strategy. Okay. But having said that, this can obviously go against us. And we will look to manage if it goes against us far enough. Generally, in terms of managing this trade, okay, in terms of managing trades, let me just mention this as well. I teach a webcast on Wednesdays called Managing an Options Portfolio, where we talk about managing a variety of trades. And we will discuss in future episodes in that Managing an Options Portfolio webcast how to manage these. But I don't want to leave you high and dry and not talk about it at all, so we'll talk about it today. If this is a neutral trade and our forecast goes from neutral to just outright bullish, we'll probably look to exit the trade and take whatever loss we have at that point, if we're at a loss at that point. Or if our forecast turns to be just outright bearish, we're going to look to get out. But very often what happens on a trade is this. You enter a neutralish trade. We go back here, and the stock moves. Maybe it goes down a little bit. And we're all, okay, bummer. I want it more neutral. But we expect it, after it goes down, to go back up, go down, go back up. We expect that to be a temporary move, and we look for the bounce. Well, maybe we have a line in the sand. Maybe it's a support level or something like that. And we'll say, look, if this goes down here and we break support, and we've just turned bearish on this, then we'll look to get out. We'll look to exit that trade, okay? So in that case, we'll look to do a stop, whether it's a true stop or like an order-based conditional type exit rule on that. Yes, we will look to do an exit. I think, hopefully that answers your questions there. Now, do we get out of both legs at once? Typically, we're going to get out of both legs at once. Now, I'm going to put aside rolling for a sec. We'll talk about rolling in a little bit. But if I just got out of the short leg, okay, it's because remember, we have a short call. I'm just going to say minus C for short call. And we have a long call, plus C for the long call. If we say, I'm going to just get out of the short leg, boom, then what are we left with? We're just left with a long call. We've just completely altered that trade from a neutralist trade to a bullish trade, which may be okay. It may be appropriate. But if you're going to do that, my counsel is this. Don't do that unless this is the type of stock in the type of situation that you would enter a long call in on its own in the first place. In other words, and this isn't just for calendar spreads, sometimes what options traders do is they get kind of in trouble. A trade isn't working out very well. That happens to all of us. But then they try to fix the trade. But they try to fix the trade, which is fine. But what they do is they're trading more out of trying to what the past trade has been than what the next trade should be. Trade for what the next trade should be. So you only want to turn this into a long call, for example, if you're looking at it and go, hey, this is a perfect setup for a long call. Then you could do that. Other than that, what I would say is you're probably going to get out of both legs at the same time there. Okay? All right. So let's go back to our Analyze tab. We talked about the effects of time decay. Time decay should be helping us out in general on this. Now, I talked about exiting also if the stock is going against, what if the stock's not going against us? Eventually, we're going to want to get out. We're not going to hold this all the way to expiration. the closer you hold it to expiration, the higher the odds of early assignment is one thing. You also increase we'll say the gamma risk on the trade, okay? We also, what that means is, it means that the trade can go from very good to very bad in a short amount of time. One of the nice things about this trade is this. Let's say the trade goes completely against us. Let's say it goes down again, goes down all the way to, let's say, 170 or something like this. That would not be a good situation to be 170. But look, we're still quite a ways from a max loss at that point. If I were to kind of look at this, and we'll go to 170 here, the loss it's showing me as of today is about 140 bucks. Okay. Well, that's not great, but it's a lot better than losing the $515 or whatever our max loss is. Okay. Even at expiration, that is showing a loss of about $211 there. So it's still a ways from our max loss scenario on that trade in that case there. That's on, sorry, and when I say expiration, that's the front month expiration. Why? Because the back month is still going to have value at that point, even if it's gone way down on us. Now, that's just an estimation of the value. We don't know exactly what that value is going to be at that point. But so that's the good thing about calendar spreads. They're slow to move against you. Now, the flip side of that coin is they're also slow to make you money as well, because we're dependent on the time decay to make us money. And that can be a slow process. So, you look up and the stock has been going neutral like what you want, or in this case, neutral to a little bit bullish. And you're going, oh, great, I've made, $10 on the trade or something like that. These are just, you have to be patient with these. So there's good and bad with the whole slow moving situation there on that. Now, here's one other thing I want to mention to you. Let me go back to this, and I want to look at Vega. This is how the options react. Let me get a fewer strikes here to make it a little easier to look at. In fact, let me go even fewer than that. Let's look at how what the Vega is on these options, and I'll explain Vega here in just a sec. So I'm going to be looking at that, and I'm going to be looking at this here. Okay. Here's my Vega. What Vega is just a measure of how implied volatilities are going to affect this trade. Well, remember, we said in general we expect implied volatilities to be going up, okay? Because we have the month before earnings go. So in this case, implied volatility is going to be hurting us to the extent of there's our value, okay? With the long contract, implied volatilities are going to be helping us. Implied volatilities on the backdated contract, in this case, June 18th, are higher than they are on the front-dated contract. And that's how it's going to be. That's how the implied volatilities are always higher the farther out you go in time. So kind of like with the time decay element of there's a differential in time, how it affects the front contract and the back contract. Same thing is true with implied volatility and Vega. Now, if you're new to options, I don't want you to stress over, the terms can be overwhelming. Time decay and Vega and whatnot and theta. I don't want you to stress over that. Just know there's a couple elements in this trade that help you out. One, time decay. We already discussed that. Another one is if IVs go up, okay? Time we know is going to go forward one day at a time. That's inevitable, right? Implied volatility going up is not inevitable. It can go down. But as I explained earlier, with earnings coming up, we would expect it to go up. All right? And so these are two big elements that can help you with your the success of your calendar spread, so that it's not just a crapshoot of the stock staying exactly where, going right to your strike price. Okay, those are the two elements. Now, there's always pros and cons. There's a bad side on it as well, and that is you really need that direction to be not exactly where you think it's going to go. You don't know exactly where it's going to go. But you also, it can't go completely out of whack, completely way up or completely way down. That's the con on this type of trade here. Okay, so let's place the trade. Let's talk about how to place the trade. I showed you in the Analyze tab, but let's go to the Trade tab and just do this. Now, I can go up here to where it says Spread Single and click on Change it to Calendar, okay? And it's kind of like, okay, these are the expiration dates, and you can just kind of click on it and go, hey, we're going to do the 190, and it's a debit spread, so I'm going to click on the ask price. It's not going to get the dates exactly right here. We said we were going to do May 15th and June 18th, so I'd have to change this to June 18th, and voila, you have your calendar spread right there. Now, this is showing a little better price than what we were showing before, but this is showing it at the mid price. Realistically, we're probably not going to get filled at the mid price. So we can do that, and we could put that trade in just that way if we wanted to. Okay? And if we wanted to, we can also, change the number of contracts. Just make sure, remember, my initial debit is my max loss. If $500 is all I'm willing to lose on this, we should only do one contract on this. And then what we can do is we can confirm and send, and we can, I don't have any groups out there right now. I'm going to just send that trade. Okay. Now, so that's the calendar spread. Now, I mentioned when we were looking at this trade, let me go to risk profile. I mentioned, this isn't really a high probability trade. How can we make this a higher probability trade? Let me get rid of that. Well, one thing we can do is you can do a trade. In fact, I'm just going to hide my positions here right now. There's a few things you can do, I guess. One, and this is a little bit more, let me think how to say this. It benefits you if there's skew in the volatility. We talked about the volatility. Here's your monthly implied volatilities right here, okay? It benefits you if the front month volatilities are higher and the back month volatilities are lower. That can be a little harder to find, but if you do find that, that would be more conducive to a calendar spread. Other things that people may consider. You could consider index options, right? Because anytime you have a stock like, say, CRM, which is our example here, there's risk of news coming out. Earnings, well, we already talked about earnings. We know when earnings are coming out, but maybe there's some other news event that drives, that's particular to this company that can drive it. If you use an index option, you still have the systematic risk of the trade, but you get rid of this individual business risk of that. But one other approach is this, is if you're looking at this, you can do what is called a double calendar. Okay? So I'm going to go and I'm going to sell a 175 put. Okay? I'm going to sell a 195 call. These are both May. Same expiration we were looking at there. I'm going to go to my later expiration, same expiration. I'm going to make another calendar. This one's a put calendar. 175 put and 1 I'm spreading them out a little wider here. I'm spreading them out a little wider. 190 call. Now, if we look at the trade, look at what we have. We have a put calendar, same expiration, same strike, different expirations on the put calendar. We also have at the same time a call calendar. Same strike, different expirations on the call calendar. We're just putting them both in at the same time. And if we do that, what we do is instead of having the tent shape, we have this kind of, is this a little bit more like a lot of those circus tent type things with the, instead of the single, pup tent, whatever, this is like, you have two peaks in this. This is a double calendar. You're absolutely right, Kelly. This is double calendar. And now if we do this, my expiration date is, that should be right. So let me set my slices to break even here. Now we're roughly at a 50-50. We've increased the probabilities on this. Now we can tweak this more and possibly even get it so it's a, a high probability trade. Every trade's going to look different. Every stock's going to look different. But there's increasing the probability is great, but we've also lowered our potential gain a little bit on this trade and increased our risk on this trade. Whether we're talking calendars or any other type of trade, there's kind of a balancing act between probability and return on risk, or probability and profitability, if you will. You increase one, it's kind of like a seesaw, teeter-totter, okay? That's what we see there on this. So in terms of managing your probabilities, managing the trade, this is still a neutral trade. It gives us a wider landing area, so to speak, for the trade to end up at. Management would still be the same. We're still getting out with about a week to go to expiration. We're not holding this all the way to expiration. And if it really turns bullish or bearish before that point, we're going to look to get out. It is more expensive, Eric pointed out. Yes, it is more expensive. Pros and cons, isn't there? Absolutely. More expensive means more risk on the trade because our initial debit is the amount of risk on that trade here. Now, last point, and then we got to quit. You can roll these contracts. We mentioned earlier, let me go to CRM. This was our trade right here. Let's say at some point this trade isn't really going where we want. We can diagonalize it. In other words, we could say, well, I'm going to buy this contract back and sell either 28, sell the same time as was, or a different date, but we can adjust the strike. Now we keep the strike the same, in which case we're just rolling out the calendar, which case we'll usually be bringing in a credit on that. But we're extending out the trade. But if we change the strike, it's no longer going to be a calendar spread. At that point, it's going to be a diagonal spread. And at that point, instead of being a neutral trade, we've turned it into either a bullish or bearish trade, depending on how you roll it there, okay? John says, if you have multiple contracts, you can sell half and redeploy a new strike. Absolutely you can. Good point, John. Thank you for bringing that up. All right? So what's the cost of the double calendar? Yeah, we'd have to look at that. I don't know if that, the cost on that, let me just clear this out. Let me go back here. You'd have to do your math on that guy right here and just add up the debits. That'd be roughly, what's 19 minus about 9, it'd be about $10. Okay, there on that, roughly. All right? Okay, everybody. Hey, coming up next, we got market and sector analysis. Thank you. I hope this was, I tried to do this I used some terms that were maybe more complex terms, but I tried to explain them very clearly. So hopefully this was kind of in English that you can understand here in terms of the basics of calendar spreads today. There's our example trade. Thank you so much for joining me. And make sure you subscribe to Trader Talks. It's the way to see the content that you want in the future. If you're on YouTube, Trader Talks Schwab webcast is the place to subscribe. All right, everybody, have a nice weekend, and we'll see you all same time next week. Bye-bye, everybody.